In this presentation, we will record the purchase and financing of equipment, putting the full purchase price, including the financed portion, the cost of the equipment on the books, and the related loan for the financing within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. In our last presentation related to the purchase of equipment, we talked about just putting the equipment on the books at the amount paid, the amount we saw clear, the bank statement, and then relying on the tax preparer at the end of the year to make any adjustments. This time we're going to talk about the fuller method, which would be to report the equipment at cost, meaning if the equipment cost $15,000, we paid $9,000. We don't put it on the books at the $9,000, we put it on the books at the cost of the $15,000. It's a bit more complex to do that, and of course we have to deviate from our system of just recording items when they clear the bank statement to do that. And therefore we're going to end up with a loan as well on the books, which is kind of a deviation from our cash basis system. We're recording more of an accrual based system because we're not waiting just until the cash is paid before we record anything under this system. Recall our issue from last time. We had the $9,000 that cleared the bank. So we were recording this and we said, hey, that's a large dollar amount. I'm going to mark it down in our open items. So we're going to go to our open items and say, hey, there's this $9,000 large dollar amount. Should we be recording it as a fixed asset possibly? It looks like it might be equipment. And then we're going to say that the client says, yes, it was equipment. Not only that, but $9,000 was only the amount that we paid. We actually financed it for the rest because it was a $15,000 piece of equipment. And we're going to say, okay, we'll put it on the books then for the cost, because that's really the more proper method to do. That makes the balance sheet account more proper. It doesn't solve the problem of us having to not work. We still have to work with the tax preparer at the end of the year because they're going to have to calculate the depreciation. But they might not more easily make the mistake of putting it on the books at just $9,000 rather than what it actually cost of $15,000. So under either method, as long as we're clear with the tax preparer, it should be okay. But this method will be more proper in that it'll show on the balance sheet, here's the cost and here's the actual loan amount. And that might help the tax preparer to then say, oh, that's the cost I need to use and not need any more information to put on the books, and then determine what the depreciation is. And they also might more easily be able to see the loan amount and say, oh, now I need to figure out how much the interest portion is on the loan. We'll talk about how to do that more in a following presentation. So what we're going to do now is we're going to go to our file. So here is our QuickBooks file for guitar lessons and equipment. We're going to go to our reports. So the reports are on the left side. And within the reports now, usually we would go to the profit and loss and find that uncategorized item and then adjust it. But of course, we already adjusted it last time. So we're going to have to go to where it is now on the balance sheet. And we're going to make an adjustment from that item. So we're going to go then to the balance sheet because this is where we adjusted it last time. We're going to change the date up top and we're going to say this is 01/01/19 to 02/28/19. So January through February 2019, run that report. You'll recall last time we set up this equipment account. We put it on the books at $9,000. We moved it out of uncategorized expense and we put it here. Now we're going to say, maybe it would be better for us to put it on the books at the $15,000 rather than the $9,000, the actual cost. That would be more proper. So we'll go back into this. And remember, you don't have to do this in two steps. You could, if this was the method we decided to do, we could do this directly in the prior presentation from the prior point in time. But if we go from here and go back into this 9,000, we're in the same spot. Here's where we entered the check. And before it was under uncategorized, now it's under equipment. Now we want to basically say, how can we make it the equipment on the books for the full cost, the $15,000? Well, one way to do it, of course, the check amount has to remain the same. This total down here needs to be $9,000 because that's what the check was for. But we want this equipment then to be $15,000 because that's the cost of equipment, and that's what we should have on the balance sheet. Just like if we purchased a house and financed it, we think of the house being at the cost, not the net cost. Because there's two things happening. There's a house and there's the loan. So that's what we need to do here. We got to go, all right, there's going to be two accounts, so it's more complex of like a journal entry or a transaction. So all we do is we say 15,000. That's what we need that to be. But now this number's not right. So how do I need to get that back down to 9,000? So what I'm going to do is have a negative number here, and that's going to be a liability account. The loan is what we'll have to put on the books. So if there's a loan on the books, I don't see any loan account here. So we're going to set up a loan payable type of account. Just going to call it loan payable. So we'll call it loan payable. That's going to be a liability. I'll say tab. And it's not going to be an expense. This is kind of the key point. It's got to be a liability. There's two kind of areas of the liability. We got long-term liabilities and we've got current liabilities. I'm going to use the current liability here, and that's because a lot of times when we finance, what it means to be current versus long-term is it's going to be due within a year versus something that's going to be due for a longer period than a year. And so a lot of times the liability, if we go by those terms, will have a current portion and a long-term portion, because some of it will be paid within a year and some will be paid after a year because we pay it on a monthly basis. But we don't really want to deal with two accounts, of course. We're going to put it all into one account. So I would choose either the current or the long term. Also note that many times a small business won't break out between the current and the long term for the loans, because you don't really need that a lot of the times for tax preparation. You would need that to be properly reported for generally accepted accounting principles. So if you needed to get like a loan or something like that, and you needed to adjust your financial statements to be in accordance with generally accepted accounting principles, you probably would have to then go through it and break that out. So we're going to go through here and enter it into the current liabilities section. So we'll put it into current liabilities. It's going to be other current liabilities. And then we're going to check the second item, which was going to be some type of loan payable type of account. So that's what we got. And we're going to say save and close. Now the amount here is going to be a negative of 6,000 because this, remember, has to be 9,000. So the loan amount is negative 6,000. And that's what we have. And that's what they told us when we had this information. They told us that the cost was 15, they paid 9,000, they financed the 6,000. So that's what we have here. Cost 15, loan 6,000. The check then still at 9,000. So we'll save and close that. We'll save it here. We didn't change the check amount, so it's okay that we already reconciled. It doesn't change the checking account at all. But now we have it on the books at the cost, which is more proper, the 15,000. It still nets out because if we go back to our reports, we have the 15,000 of the equipment, but we also have this liability of 6,000. And of course, this is good on the books. This is bad on the books. And the difference between those two is the 9,000, which is what we actually paid. That's what came out of the checking account. So the check, of course, is still in the checking account. I'm going to minimize this at that 9,000. And if it's just broken up, the other side of it, the balancing side of it, is now on the 15 and the 6. So, and that gives us the whole balancing equation with 3 basic accounts now. So now we have this option. We still have to tell the tax preparer, we still have to tell them, hey, there's a $15,000 piece of equipment. You've got to figure out the depreciation on it because it needs to be depreciated in accordance with tax depreciation. So we still have to tell them that no matter what. And the loan down here, same kind of thing. We got to say to the tax preparer, hey, there's a loan and there's interest on the loan because we're going to pay interest and that's deductible. So then we're going to have to deal with the loan in some way. So under either method, we're going to see these loan payments, and we'll deal with loan payments later in another presentation. But notice when we do deal with it, what we discuss will be applicable every time there's a financing of something. And so we'll see that in future presentations. For more accounting information and accounting courses, visit our website at accountinginstruction.info.